If you're finally starting to get paid and now your boss comes to you and says that, hey, you can invest your money in a 401k or a 403 or a 457 and you have no idea what these things mean and you don't know how to invest your money and you want to start investing for the first time, you are in the right place. What's up everybody, I am Jaspreet Singh from theminoritymindset.com where money minds rethink rich. Making your first investment can be scary and it's a whole new world that most of us are never exposed to. You hear all these terms like the IRA and then the 401k and then some of you might be hearing about a 403b or a 457b, and now you don't know where to start. Do you take one of these tax-deferred retirement accounts, or do you open up your own investment account, or do you start investing in mutual funds or index funds or ETFs? And so in this video, I want to start breaking all of this down. That way you know how you can start investing for the first time. That way you can make smart decisions with your money. That way you can build up this new nest egg that will make you wealthy. The inspiration for this video came because a good friend of mine who is now a brand new doctor got his first job and is finally starting to get paid, and his boss offered him a few different investment options, a 403b and a 457b, and he had no idea what these things were. He did not know what an IRA was, and so he called me and asked me, how do I make my first investment? This is the first time I'm starting to make money, so what do I do with my money? How do I now build wealth? And unfortunately, regardless of how much schooling you go through, most of us are never taught a thing about how to invest our money to become wealthy. That way we can actually be financially free. So here's what I want to do. I want to start by going over the different tax-deferred retirement accounts. These are things like the 401k, the IRA, the 403b, the 457b. I want to go over what they are, how they work, how to invest in them, and then I want to give you my thoughts on them. That way you can get my opinion. After that, I want to go over ways that you can invest your money yourself. This would be things like mutual funds, ETFs, stocks, and then I want to go over alternative investment options. That way you can think outside of the box and know the different ways that you can invest your money. That way you can build your wealth. So let me start here with the tax-deferred retirement accounts. But before we do that, I need you to do me a quick favor and smash the thumbs up button below. And if you haven't already, be sure to join our free Discord server called the Guac Talk community. We call it Guac Talk because, as we all know, extra guac is truly a symbol of extra wealth, and in this community, you can chat and network with other minority mindset thinkers. You can chat about the stock market, the real estate market, the cryptocurrency market, and all things building wealth. This community is completely free, so if you want to join our free Discord server, I'll put the link to where you can do that in the description below. These tax-deferred retirement accounts are the most popular ways for people to invest your money because a lot of these are completely automated. When you invest in your 401k or your 403b or your 457, a lot of times you're going to be working directly with your employer, and now your employer is going to help you set up this account, and anytime you get paid, some of your money is directly going to go into your retirement account, and this money is going to sit there until you hit close to retirement age, and then you will be able to pull your money out. The reason why people like these tax-deferred accounts is because they are tax-deferred. You have the option to not pay any taxes on the money that you invest today, or you can pay your taxes today, and then you don't have to pay taxes when you pull your money out in the future. So within all four of these accounts, you have a traditional version, and then you have a Roth version. The traditional version, so a traditional 401k, traditional IRA, traditional 403b, traditional 457b, all these things mean that you do not pay any taxes today. You invest your money today, and then this money gets to grow tax-free. So every time you make a profit, you don't have to pay taxes on it. And then when you start pulling this money out when you're a whole lot older, that's when you pay taxes when you pull the money out. With the Roth, it's the opposite. With the Roth option, Roth 401k, IRA, 403b, 457b, you pay taxes on your money today, and then this money goes into your account. I'm gonna go over why the tax difference matters and which option is better for you in just a second, but let's start by going over what the difference between these different retirement accounts are. So your 401k, your 403b, and your 457b are all essentially the same thing. It's just who can offer that plan. Your 401k is typically reserved just for your private companies, your private employers. You do see some government companies or some big nonprofits offer 401ks, but most of the time it's only going to be a private employer. Your 403bs are for government employees and for your nonprofits. And then your 457 plan is for people like teachers and first responders and city officials. The biggest difference between these three plans is going to be with your 457b, because what the 457b says is if you pull your money out of your retirement account before you are 59 and a half years old, you don't have to face a penalty. But if you pull your money out with a 401k or a 403b before that 59 and a half years old, then you're going to be subject to a 10% penalty on the money that you pull out. So this has a little different rule where you can pull your money out and you don't got to worry about that fee, but you got that fee here. The next major difference isn't on the legal side, it's more on the practical side, because what you're going to see happen with a lot of companies is a lot of companies are going to give you some sort of 401k match. If you invest $100 into 401k, they might give you $30 or $100. They might match a dollar for dollar, just depending on who your corporation is. But a lot of times you're not going to see those types of matches in the 403b and the 457b just because of the way that they work. So a lot of times you're not going to see the same match options here, but you will see that here, which makes the 401k more attractive to a lot of people. So the way that these accounts work is you can open up a 401k, 403 or 457b. Your employer will tell you how. Once you open an account, you will be able to automatically invest some of your paycheck into these accounts. Again, you could do the traditional way or the Roth way. I still got to talk about that. But you can invest your money into these accounts. And once your money is in these accounts, you can kind of decide how you want your money invested. Now, you're not going to be able to invest your money completely by yourself. Typically, what you're going to do is you're going to pick which kind of funds that you want to invest your money in. So you're going to be limited typically as to who and where you can invest your money, because when you open these accounts, your employer is working with some sort of institution on how you can invest your money. So you'll typically get some sort of brochure, some sort of investment pamphlet that will go over your different investment options, and then you'll be able to see where you want to invest your money. And then you'll be able to pick, do you want to be more aggressive with your investments? Do you want to be more conservative with your investments? And based off of that, your money will be invested into these funds based off of what your investment criteria are. The thing that I need you to please understand are fees, because what so many people do not understand about these retirement accounts are the fees that they're paying. Now, at this point, you might be thinking, wait, my 401k is charging me a fee? Yes, they are. When you invest your money into these funds charge a fee to manage your money. And some funds are going to charge you a whole lot more than other funds. So what you need to do is you need to look at something called the expense ratio. This expense ratio is going to tell you what the fees are for the funds that you're invested in. Some of these fees are going to be upwards of 1% or even 2% of your assets a year. That means if you invest $100, they're going to take $1 or $2, depending on what the fee is, right off the top every single year, whether or not you make money. But there are other accounts that will charge you a fraction of that, and they will get you similar returns. So if you have a retirement account right now, do me a favor, open up your brokerage account and see what your expense ratio is. That way you can see what it's costing you every single year. Generally, now this is not something that you need to always follow, but generally, if it's costing you more than 0.75%, that would be considered a high fee. So just something to keep in mind. An IRA works essentially the same as these other three, except now you're not doing it through your employer. You're managing your IRA on your own, because an IRA stands for an individual retirement account. So this means you can go to your bank, you can go to any financial institution, you can open up an IRA, and now you are the one in charge. You're not doing it through your employer. You can create an IRA wherever you want, and then when you create your own IRA, you have the option now to, again, invest the money the way that you want. If you go to a specific brokerage or if you go to a specific bank, they're going to give you their own investment options, or you can create something called a self-directed IRA, where now you have the ability to invest your money yourself. But essentially, the thing that you need to understand about an IRA is that this is a way for you to invest your money on your own and get those tax benefits that people look for with these accounts. Each one of these retirement plans have a contribution limit, meaning there's a maximum amount of money that you're able to invest into these accounts in 1 year. So for example, the 401k, the 403b, and the 457b have a maximum contribution limit of $20,500 in 2022, and the IRA has a maximum contribution limit of $6,000 in 2022. The whole idea behind this is the IRS and the government doesn't want you to take 100% of your income and put it into these accounts, because then you could just not pay any money in taxes on your income today, and the IRS wouldn't like that because they need their tax money. Which brings me to the topic of understanding the difference between a traditional or a Roth investment. So again, a traditional investment means that you're going to pay taxes on the money that you invest, not today, but when you pull it out. And a Roth investment means you're going to pay taxes today, and then you're not going to pay taxes when you pull your money out. The reason why people like this traditional investment is because, well, you don't have to pay any taxes today. You invest your money into your account, you let your money grow, and then when it comes time for you to retire, you're going to pull your money out, and that's when you're going to pay taxes. The reason people like that is because people say, okay, well, when I pull my money out, I'm going to be old, I'm not going to be working a job, so even if tax rates go up, it's not as big of a deal because, well, I'm going to have no income. And if I have no income, then my tax rates are going to be lower. So when I pull my money out, I'm going to have a lower tax rate, so I can pay less taxes because now my money can grow essentially tax-free. Then I pull my money out, and then I'll pay taxes when I have no income at a lower tax rate. People who follow the Roth model will say, well, I don't know what's going to go on with tax rates. I think that because the United States national debt is skyrocketing and I don't see our national government spending slowing down, I think the government is going to want to raise taxes. And if they raise taxes, it will be more beneficial for me to pay my taxes today than when I pull my money out. Plus, you might also be thinking, hey, I'm investing a lot of my money. I'm trying to build more income. I'm trying to build assets. So my goal is when I turn 60 or 65 is not to have a little bit of income. My goal is to have a whole bunch of income when I'm older. So it's more beneficial for me to pay my taxes today because I want to really be wealthy and I want to create a whole bunch of income streams. So you just got to figure out what your goal is and what your financial plan is. If you plan on not doing anything and not having any other income when you're 60 and not having any assets or investments that are going to pay you, then sure, a traditional is going to make more sense. But if you plan on buying additional assets every single year and you plan on building and stacking your additional streams of income, that way by the time it comes to your retirement, you're going to be having a whole bunch of income, well then this is going to make a whole lot more sense. This is what a lot of the minority mindset people do because we're working to build assets. We're working to create new income streams. That way you can make a whole lot of money, not a little bit of money as you get older. Now that you understand how these tax-deferred retirement accounts work, let me tell you my opinions on them because I don't have any of these tax-deferred retirement accounts. I invest my money on my own. I don't use any of these tax-deferred retirement accounts because for me, I can get better tax breaks and get a better use of my money today instead of using one of these accounts. Now let me make sure that I'm very clear with this because what I do isn't for everybody. For the average person, hey, these are fine. But I am very involved with my investments. I like to be active with my investments. I have different strategies and different goals with my investments which give me different tax breaks. And because of that, I don't have any use for these investments. But if you are not into investing your money, if you're not really into being that involved with your money, you're just looking for passive ways to invest your money and you don't want to create whole new streams of income, then hey, this is a great way for you to get some tax benefits and invest your money on the side. I don't like the idea of my money being tied up in an investment where I can't pull my money out if I wanted to. And if I did, I'm going to be penalized. I don't like the idea of my money being tied up in an investment where I don't have a say of how my money is going to be invested. And I don't like the idea of my money being invested into a fund where I can't control the fees or where now I'm subject to higher fees than if I just invested that money into a fund outside of one of these retirement accounts. My investment goals are very different than most people's investment goals because I'm not working for a traditional retirement. I'm investing my money very differently, which is why I don't need these and I don't need to create a fund where I'll be able to access it when I'm 60 years old and then have this nest egg that I can live off of. That's not my investment goal. But again, for the average person, if you're just starting off, this is a great way for you to start, but this should not be your sole investment plan and it should not be your sole retirement plan, which brings me to number 2, investing your money yourself. You do not have to invest your money into a tax-deferred retirement account or to a 401k to invest your money. There are ways for you to invest your money outside of these accounts, and if your employer is not giving you a match or if they're not giving you free money to invest into one of these retirement accounts, then you might get some extra benefits by investing your money yourself because now your money is not tied up anywhere. Now, you're not going to get the same tax benefits here than you would if you used a 401k or an IRA or a 403b or a 457b, but now you have the full control over your investments and you can access your money anytime you want. There are 4 very accessible ways for you to invest your money into the stock market without going through your traditional tax-deferred retirement account. You can invest in a mutual fund, you can invest in an index fund, you can invest in an ETF, and you can invest in stocks. All of these things allow you to invest in stocks just in different ways. So the stock market is a place where you can go to invest your money into your favorite companies, and it is a way for you to bet on the future of our economy. So if you think the economy is going to go up, well, now you have a way to invest and get a share of that upside by investing your money into the stock market. If you go out and you buy 1 share of the Amazon company, well, now you become one of the part owners of Amazon. The reason why this can be intimidating or this can be hard is because a lot of people don't want to spend the time, effort, or research trying to figure out which company to invest in, or they don't want to be an investor themselves. They just want it to be passive. They want to invest their money and get some of the upside. This is why things like the 401k and the IRA have become so popular, because they are a very passive and easy way for someone to just invest their money and let their investments do their thing. But the thing that you have to understand is that your 401k and your IRA were never intended. They were never intended to be your sole retirement plan. Even the founder of the 401k has come out and said that the 401k has gone awry because everybody believes that the 401k is all they need in order to be financially successful when they retire. but that's not the case. You're going to have to invest more money outside of your 401k, which means you need to invest your money yourself, but that doesn't mean that you have to be doing stock picks. It doesn't mean you have to actively manage your investments every single day if that's not what you want to do. There are other ways for you to invest your money outside of your tax-deferred accounts, which are also passive. Mutual funds, index funds, and ETFs all work very similarly in that they are a basket of stocks. When you invest in any one of these three, what you're doing is you're investing into a fund that's giving you exposure to a whole bunch of stocks. So instead of you trying to invest in 100 different companies, you can invest in a fund that's invested in 100 different companies, and now you're getting exposure to these 100 different companies without having to actually invest in every single one. The whole idea here is you are limiting your risk because now you are not trying to figure out which companies to invest in. You're putting your money into a fund, and these funds invest in a whole bunch of companies. It might be 30 companies, it might be 500 companies. So this fund invests in a whole bunch of companies, and you're getting exposure to all these companies to lower your risk. That way now, if one of the companies in your fund goes bankrupt, you're okay, because now you still have a whole bunch of other companies which are going to help balance out that loss. Each one of these funds work a little bit differently. A mutual fund is known as an actively managed fund, which means that now this fund has a manager, a money manager, who is getting paid to now find the best company to invest in. So this person is now going to be buying and selling stocks, they're going to be researching companies, and they're going to be trying to get you the best returns possible. That's what a mutual fund is. An index fund and an ETF are passive investments. That means instead of having an expensive money manager, you have a computer, and this computer has an algorithm, and this algorithm is going to say, okay, we want to invest in, let's just say, the biggest 500 companies on the stock market. And now if one of the companies in your list goes lower or they go bankrupt, this computer is going to kick that company out and put a new company in. So it's passively managed, which means that here and here, your fees are a whole lot less than here, because now you have to pay for an expensive money manager. So this is one of the reasons why people really like ETFs and index funds, because your fees are a whole lot less, and most money managers, most mutual funds cannot outperform the market year after year after year, especially after you factor in the fees. So here with this and this, you can just get exposure to the market. When the market goes up, you get the same returns. When the market goes down, you will also see your fund go down. There are ways for you to invest in the general stock market. There are ETFs and index funds that give you exposure to the general stock market, and your fees are a whole lot less. So here, you're paying less fees, and you can get the general returns of the stock market, versus here, you're trying to beat the stock market, but you're gonna pay higher fees, and most money managers cannot beat the stock market over the long run. ETFs and index funds work very similarly, except the way that they trade, because ETFs trade differently than index funds. ETFs trade just like stocks. You can buy and sell shares of an ETF just like any other stock. You can buy it in the morning, sell it in the evening if you wanted to. Don't recommend doing that, but you can. And you have no investment minimum to invest in an ETF. Sure, you just need the money to buy the share of an ETF, unless you're buying fractional shares of it, but you have no investment minimum. Versus an index fund, you're typically going to have some sort of investment minimum. It might be in $1,000, it might mean $10,000, depending on which index fund you're investing in, but you have an investment minimum, and you can't trade it the way that you can in ETF. With an index fund, it's not trading all day long. It usually just makes one trade in the morning, and that's it. So if you want to sell your index fund, you would have to wait until the next day, as opposed to an ETF. You can trade it just like any other stock. In terms of your actual investment though, you're getting the same thing here and here. You're both getting your low cost to invest, and you get kind of the same investments. Like you have ETFs that give you exposure to the top 500 companies in the stock market, and you also have index funds that give you exposure to the top 500 companies in the stock market. So the whole idea with index funds is it's really made just for the long-term investor who is not interested in trading. It is just a very passive way for you to invest your money for the long term. With ETFs, same concept, except now you can trade in and out of it very easily. And then you have the ability to invest in individual stocks. So these are more of your long-term, your passive ways to invest your money in the stock market. If you don't want to be an active investor, if you don't want to research companies, if you don't want to keep up with all the financial news, hey, just invest your money in any of these three, and now you have an additional way to invest your money. You just keep putting money into these investments every week or every 2 weeks or every month. You're just going to keep investing in these things when the market is up and down. You're just going to keep putting money in there, and you're going to let your money grow and compound over time. So that's the strategy here. With stocks, it's very different. If you want to be more active with your investments, you have the ability to earn more money, because now you can try to find the best companies to invest in. Now, obviously, that has more risk, because you can invest your money into a company and then see it go bankrupt, and how you lose your whole investment. but you also have the ability to earn more money because now you can invest in a company before it really just takes off. Because if you can research companies, you find a company that you believe is hot, and then it takes off after you buy it, well now you get to share in all the upside because you are an owner in that company. The mistake that so many people make when they're investing in the stock market is first they ask, okay, I want to invest my money in the stock market. What stock should I buy? Instead of trying to figure out, okay, what is my strategy? What is my goal? How do I want to invest? They just want to know what stock do I buy. And then what happens is they buy on emotion. They say, yeah, I want to be a long-term investor because everybody knows that your long-term investors make the most money sustainably. You can make a lot of money in the short term as a trader, but traders also lose a lot of their money. I mean, something like 80% of traders end up losing money over a period of 12 months. But now you say, okay, I want to be a long-term investor because I know that's how I can make money. That's how Warren Buffett made all his money. I want to be a long-term investor. And now you find a hot stock to invest in, you put your money in there, and then 4 months go by and you see your stock in the red. You see your stock down. And now you start to panic. They have a bad earnings, they have a bad quarter, and now you start to get really worried. You don't know what's going to go on with this company. You're losing money, and now you sell. You panic, and you just get out, and now you lost money. This is where you need to have a strategy, and again, why if you want to be investing in stocks, you have to understand what that entails because now you need to be doing the research. The way you do that as an investor is you have to look at the fundamentals of a company. That means you need to understand the cash flows. You need to understand the profit and loss. You need to look at all the financials. Look at the numbers. Are they profitable? If so, how are they profitable? How much money are they making? Where are their expenses? Where are they investing? If they're not profitable, how do they plan to be profitable? So you want to look at the numbers, come up with a valuation. Then you also have to look at the non-numbers. You need to look at the company itself. Who are the executives? Are they innovating? What kind of products are they creating? Do they have a loyal fan base? How hard is it for another company to come in and compete? What is their real secret sauce? What makes them special? If you can come up with this and you can come up with a good valuation, then you can look at the actual trading price of a company, and then you can say, hey, I think this company is undervalued and it has a lot of upside. And so that will be an opportunity for you to invest. But if you look at the numbers and you say, you know, I think this company is too expensive. I don't want to invest. These are the type of questions you need to be asking yourself, and this is what every fundamental long-term investor is doing. They're looking at companies, they're trying to see what these companies are doing, and they want to value these companies based off of their own metrics, and based off of that, if the company is trading for a price that is lower than what they think their valuation is worth, then they're going to come in and buy. If the company is worth more than what they think it's worth, then they're not going to buy. This is what you need to be doing as an investor, and it takes time and it takes practice. We're going to jump back into the video in just a second, but before we do, I want to talk to you about our Market Insiders program, because if you're interested in investing your money in the stock market and the real estate market, our Market Insiders program can really help you with that. Market Insiders is not a class. It is a weekly group coaching session. Every week, you're going to get access to a live class where you'll learn something about how to invest your money in the stock market and the real estate market, and because these classes are live, you will be able to apply what you learned to the real world. So for example, let's assume that this week's coaching session is on the topic of how to read a cash flow statement. That means for the first half of the class, you might go over what is a cash flow statement, how to find a cash flow statement, what it means, and how to understand it. And for the second half of class, if Amazon released the earnings statement this week, you might actually go over Amazon's cash flow statement. That way you can apply what you learned, since all of these coaching sessions are live. The real estate coaching sessions work the exact same way. You're going to go over a lesson like how to understand the cash flows of a property or how to find an undervalued property, and then you're going to apply what you learned to today's market. As soon as you enroll in Market Insiders, not only are you going to get access to our stock market and our real estate coaching sessions, but you're also going to get access to our stock market beginners class for free that will walk you through everything you need to know to get started investing your money in the stock market. And you're also going to get access to all the previous coaching recordings, that way you can go back and learn more, and you're going to get access to our private community of serious investors. This is our exclusive Discord community that's made just for Market Insiders, and you can go into this community, network with other investors, and you can ask your questions. When I was working to create Market Insiders, there were two things that were very important to me. First, the coaches, because I wanted to make sure that the teachers were real investors, and second, the pricing, because I wanted to make sure that it was very affordable. First, talking about the teachers, all of our coaches have been vetted. These are not some random gurus that we found. These are real investors, people who have been investing their money for years, people who've gotten great returns, and people who have the money behind them. We're talking about hundreds of thousands, if not millions millions of dollars invested themselves. So these are real investors who are doing what they teach. And on the price side, it was very important to me that Market Insiders was an affordable program. I didn't want to create a program that would cost you $1,000 or $900 to get started with Market Insiders. I mean, it costs less than the price of dinner for two if you want to get started with Market Insiders. And you don't even got to take my word for it, because I know there's a lot of crappy products on the internet. You can try out Market Insiders for free. We have a free 10-day trial where you can go through the entire Market Insiders program, and then you can decide if it's right for you or not. During this free trial, you're going to get access to everything. You're going to get access to our group coaching sessions. You're going to get access to our free stock market class. You're going to get access to our previous recordings, and you're going to get access to our private community of investors. This way, you can try it out and then decide if it's worth the money or not. If you start Market Insiders, you try it, and then you realize that you hate it, well, then you can cancel your membership during your free trial, and it won't even cost you a penny. But if you start Market Insiders, you try it, and then you love it, well, then you can decide if it's worth it or not for you. This way, you literally have nothing to lose. So if you want to learn more and get started with your free 10-day trial to Market Insiders, I'll put the link to where you can get started and join with the free trial in the description below. And this brings me to number 3, alternative investments, because there's more ways for you to invest your money outside of the stock market. Like, I love investing my money in real estate. I also have money in cryptocurrency. I also have money in commodities like physical gold, and I also invest in startups and other businesses. There are ways for you to invest your money outside of the stock market if you want to be more involved with your money, and these allow you to get paid in a variety of ways. Let me start by talking about real estate. When I invest in real estate, I don't just buy a property with the goal of trying to sell it for a huge profit. When I buy property, my goal is to get cash flow. So if I buy a property for, let's just say, $150,000, I'm gonna buy this property not with the intention of selling it for $200,000. I'm buying it because now I know that this property is gonna rent out for $1,500 a month every month, and now what I've done is I've created a new passive stream of income. So now I own this asset, I own the real estate, somebody's gonna live there, a family's gonna use this property, they're gonna live there, they're gonna get the value out of this property, and in exchange, they're gonna pay my company, my real estate company, rent every single month. And now $1,500 is coming into my account every single month, and I don't really have to do any work. I have a property management company who I've hired to do all the day-to-day work, and they're the ones that when something goes wrong with the property, they call the property management company. So yeah, all the $1,500 isn't profit. Some of that money is going to the property management company. Some of the money is going to taxes. Some of the money is going to go to maintenance fees and management fees. And if you have a mortgage on the property, some of the money is going to go to debt. But if you do it right, it's also going to put some money in your pocket every single month passively, and now what you've done is you've created a new stream of income. Plus, as an attorney who's not your attorney, I can tell you that real estate also offers some of the best tax breaks that our tax code has to offer. So when you invest in real estate, not only can you get cash flow, but you can also get legal tax breaks. With cryptocurrency, it's very different. Cryptocurrency is a much more speculative and it's a much more risky and volatile investment in the sense that you can see cryptocurrency rise and fall very fast. But you have to understand, again, why are you investing? I like cryptocurrency because it's the people's movement of money. People are losing their trust in the Federal Reserve Bank, they're losing their trust in the Treasury Department, and so people are looking for alternative ways to store their money, to store their wealth, and one of the ways that they're doing that is with cryptocurrency, and you also have a lot of powerful technology behind cryptocurrency. Again, very risky, and if you don't know what you're doing and you just dump your money into it, then you might be very disappointed if you see cryptocurrency prices go down. Again, this is where education is so important, and if you want to learn more about cryptocurrency, I'll link an interview that I did with a cryptocurrency expert going over how cryptocurrency works and how you can invest in it, and I'll link that for you in the description. With gold, is very different. I own physical gold, not a gold ETF, but actual physical gold, and I look at gold as real money. I don't look at gold as an investment. I don't care if gold prices go up or down. For me, gold is real money because it represents a store of value. It takes time, effort, and labor to mine an ounce of gold, so it really represents value as opposed to our dollars, which aren't backed by anything tangible. It's not backed by gold or silver or anything else. It's backed by a promise by the United States government that our dollars have value. And because of that, the value of our dollars can be manipulated, they can be diluted, and so I own physical gold as a protection against that. But again, I don't look at gold as an investment that's gonna make me rich. I look at gold as an asset, as a money that I keep as a store of value. And then I invest in businesses because I'm an entrepreneur and I love working with other entrepreneurs. Obviously, we have here Minority Mindset, a company, but I also invest in other startups. So I like working with other startup founders. And the way that I work with these companies is not just by giving them cash, but I like actually working with the companies. I like working with the founders to help advise them, to help them grow. That way we can take this company and help solve more problems, which will help the company grow even bigger, because an entrepreneur's job is to solve a problem. If you can solve a problem for a lot of people, well, now this company will be able to grow bigger. So this, again, is highly risky. You can lose all of your money by investing in startups, but you also have the ability to earn more money, because now if a company that you invested in grows big and then they go public or they get acquired, well, now you can get a big payday. But again, highly risky, and you have to be involved to understand what you're doing, and you have to be willing to understand and take that risk. Now, some of these can be very hard to do. Like investing in real estate can be difficult because you need access to a lot of capital. And investing in businesses can be hard because if you want to go out and invest in a startup, you might need a lot of money or have the right connects to do that. And investing in gold can be hard because you don't know where to do that. So these things can be difficult, but technology has made it easier for the people that are willing to learn. For example, with real estate, you don't have to invest in physical real estate to get exposure and the upside of real estate. You have platforms out there which allow you to invest in crowd-funded real estate. That way now, you don't have to buy an entire property. You don't have to be the person that deals with tenants. You don't have to be the person that gets the call when the toilet is broken. You're just investing into a fund which gives you exposure to that type of real estate. With businesses, before, if you wanted to invest in a startup, you had to go and find the companies and go pitch to the startup or have the startup pitch to you. Instead, then you had to find the right companies. They'd have to come to you and make a deal to invest in them. Now, thanks to crowdfunding, you can invest in startups with as little as like $100, and now you can go and invest in some of these companies. Again, highly risky, but now you can get exposure to these companies at an early stage. That way, if they go big, you got in early because now you were able to do that thanks to technology. The key for any of this to work is that when you get paid now, you have to allocate a portion of your money to your investments. If you're just getting started, that might mean the 401k or IRA or 403b or 457b. But as you start to be more involved and as you start to see the upsides of investing and as you want to be more active in your investments, you might say, hey, I want to see what other investments there are, or how can I be more involved in my investments, or how can I invest my money myself? This is where you have to understand, okay, I'm getting paid, you take a portion of your paycheck, this is money that I have to invest. Now you can see all the different places that you can invest your money because different investments will have different upsides, different goals. Real estate is cash flow. Gold is preservation of your wealth. Cryptocurrency, you're trying to see more upside. In business, you're trying to see more upside as well by investing in these early stage companies. So every investment has a different goal, and when you have that goal, now you just need to understand where you want to invest. And this is where your financial education comes in, but it all starts with understanding how to take that initial money and knowing where to put it. That way you can start to see that upside and start to use your money as a tool to build your wealth. If you like what you saw so far, then you're gonna love this. Financial planning is one of those things that we're all expected to know how to do, even though most of us are never taught how. Well, maybe if you had financially savvy parents, they told you to save a little bit of money, and maybe if you're up for it, invest a little bit of money too. The problem is, if you don't give your money a plan, then your money will leave. Money, where'd you go? Come out, wherever you are. The majority of people have a 3-part financial plan that looks something like this. They make money, and then they spend money, and then they wonder where all their money went. Okay, money, you can come back now, but it doesn't have to be like that. Look, if you can order Chipotle with extra guac and get it delivered to your doorstep without ever leaving your sofa, then you can come up with a budget that will help you build your wealth. You just want to make sure that your budget sets you up for building wealth instead of just getting by, because there's a big difference between these two types of budgeting. The first thing you need to do is figure out where all your money is going. Money, where? Oh, there you are. Why do you keep hiding from me? This is the part that nobody likes doing, because you're gonna have to talk with yourself about your spending habits. What did I tell you about paying $700 for scarves? It's almost like when you were in high school and then your teacher would pass back your test results and you would see that, oh my God, you were so close to an A, but you had made 15 careless mistakes. Maybe that was just me, but you have to do the same thing now with your money, except you have to be the one that grades yourself. We're gonna do this the old school way, so I want you to clean off your kitchen counter and bust out your bank statements, your payroll statements, and your credit card statements. Now, write down how much money you made last month, and then write down where all of your money went. So write all of your expenses and write how much money you saved and how much money you invested. Wow. Before you can make a plan on what to do with your money, you need to know where all your money is going. So guac is really extra, huh? Hopefully looking at your money is going to be the inspiration that you need to go out and make a better plan with your money, because that's exactly what we're going to do now. An average financial plan does two things. It tells you how much money you can spend, and it tells you how much money you should save. A good financial plan does three things. It tells you how much money you can spend, it tells you how much money you need to invest, and it tells you how much money you need to save. A great financial plan automates your good financial plan. You got to come up with the best ratio of spending, investing, and saving for you, or you can follow our 75-15-10 or 50-30-20 plans. If you are older and you have financial responsibilities, you can follow our 75-15-10 plan, which says that for every dollar that you earn, you can spend a maximum of 75 cents, you should be investing a minimum of 15 cents, and you should be saving a minimum of 10 cents. If you are younger and you don't have financial responsibilities, this is your time to double down and build your wealth, so you can follow our 50-30-20 plan, which says that for every dollar that you earn, you can spend a maximum of 50 cents, you should be investing a minimum of 30 cents, and you should be saving a minimum of 20 cents. The easiest way to force yourself to stick with your plan is to automate it and create 2 or 3 different bank accounts. One bank account is going to be your checking account. This is the money that you can spend. One bank account is your savings account. This is your money that you're saving for emergencies. And one bank account could be for your investment money. I say that one bank account could be for your investment money because it depends on your financial goals. Some of you might just want to be very passive investors, where every month a percentage of your paycheck is automatically invested for you and you don't want to be hands-on with your money. If that's you, then you don't need a separate bank account for your investment money, because this money can automatically be withdrawn from your checking account and just go straight to your investment account. If you want to be more active with your investments and you want to pick and choose what your investments are, then it helps to have a third bank account where you take the cash that you want to invest and put it into this bank account. That way you can easily see how much cash you have waiting to be invested. The reason it helps to have a different bank account for your spending money and your saving money and your investment money is because you don't want to accidentally spend your investment money on a new TV. Your spending account has all the money that you're allowed to spend. So this is the money you can spend on your rent, your mortgage, your groceries, charity, and everything else. Once the spending money is gone, you're not allowed to spend any more money. That's it. You got to know how to live below your means. Your investment money is the money that you're using to build your wealth faster. You can use your investment money to pay down your debt faster. You can use it to buy stocks or real estate or start your own business. The main thing with your investment money is this money needs to be used to buy assets, which are things that pay you. You do not want to use your investment money to buy liabilities, which are things that just take money away from you. And your saving money is your emergency cushion. This is the money that you can tap into if you run into a tragedy or if you lose your job. This is the cash that you have to protect you from these emergencies. But here's the catch. You don't want to just save your money just to save it forever, okay? Your savings are losing value to inflation, so you want to be thinking bigger. Once you have 6 months worth of expenses saved for an emergency, this is not money that you're saving for a down payment on a home or something else. This is just cash you're saving for an emergency. Once you have 6 months of these expenses saved, now you want to start thinking about reallocating the saving money either to your investment or maybe a little bit to your spending money too. Making a budget is the easy part. The hard part is sticking with it. Thankfully, we're in a digital age, and you can turn your good budget into a great budget by automating this whole process. If you know that $5,000 are coming into your bank account every single month, then you can create automatic transfers that move 15% of this $5,000 or $750 into your investment account, and you can move 10% of this $5,000 or $500 into your savings account automatically. Now, you're putting your money to work in the right places before you even get a chance to spend it. Now, when it comes to spending, you are forced to live below your means because you have less cash left over in your spending account. Your savings are slowly building you a cushion, that way you have something to fall back on in case an emergency happens. And for your investments, well, this is where you need to know yourself and your risk tolerance. The most risk-free way to invest your money is to pay down your debt faster, because if you're paying 6% a year in interest on your student loans and you pay off your student loans a year early, well, you just got a guaranteed 6% return on your money, because that's 6% in interest that you don't have to pay to your bank. If you want to be more of an active investor but you don't really want to go into the details of analyzing companies and stocks, then you could look into investing in index funds. You can think of an index fund kind of like a group of stocks. When you go out and you invest in individual companies or stocks, there's a risk that the company that you invest in is going to go bankrupt. And if that happens, your investment is going to go to zero and your investment money is going to be gone. But if you invest in index funds, now you're not investing in individual companies, you're investing in a fund that invests in a whole bunch of companies. Now, even if one company goes bankrupt, you're okay because there's a lot of other companies in the fund to balance that one bad company out. So this is your lower risk way to invest your money into the stock market, because now you're not investing in an individual company, you can get exposure to the entire stock market as a whole. If you want to be even more involved with your investments, then you can look at investing into individual companies, or my favorite, investing in real estate. This takes more time and effort on your part, because if you want to invest in individual companies, you got to be doing your research to make sure this company is growing and it's a good stock. And if you want to invest in real estate successfully, you got to build a team, you got to know the location, and you got to make sure your tenants are paying rent. Being more active with your investments comes with more risk, but it also comes with more potential return. Look, investing is not a guaranteed thing, okay? You are never guaranteed to make money when you invest. You might even lose money, which is why you have to do your own due diligence, and it's why you want to never blindly listen to a random guy on YouTube. But now you're building a financially healthy lifestyle, that way you can live a wealthy life. It's not easy and it's not a quick overnight thing, but it will work if you stick with it and you work for it. So now, the real cost of this jacket isn't $150. It is almost 10 hours of my time, and it is the opportunity to make $1,100 over the next 30 years. Now you can ask yourself, do I really want to spend $150 on a jacket now? Too late, I already got it, Josprit.